Hi, today we'll be looking at the market message, the market overview for the past week. Um, this is very broad based, kind of just looking at the major asset groups here. Some of the more interesting things that took place were the S&P 500 shown here. It did show strength throughout the week, even amid rising interest rates. Where we stand today at the bottom 15-minute chart, there is a slight consolidation, kind of above those key moving averages. It looks like after the last few months of volatility, we may get a breakout higher. Obviously, I'm going to wait to see that breakout before I start to buy. This would necessarily give the green light to, own equities. I might buy some call options in the SPY itself. Over the last couple of months, you did see kind of a quick breakout following the February volatility. That obviously failed. Again, in March, another potential tried breakout that failed. But this time, it has been a few months. Volatility is normalizing a bit. And so this just looks like an interesting play here potentially. So obviously, continue to watch this. U.S. equities have been relatively stronger than its international peers that we've seen. Emerging markets have faced difficulties, but this is definitely an interesting place to be. Another important aspect of financial markets right now are rising interest rates, specifically the 10-year interest rate. I think we got up as close to 310 last week. It did settle back a bit to 307, but you can see on the 15-minute chart below, it looks like a clear breakout higher above that 3% range. And, as you've seen since late 2017, it's been a kind of steady trend higher with only a slight pullback in April. Looking at the top chart of the 2-hour, there was obviously a quick breakout higher following the presidential election. That kind of subsided throughout 2017 mostly, picked up late 2017, and now it looks like we're kind of in some a resumed uptrend. Looking at the middle chart, that's the 1 month, and that brings you all the way back to 1980. So it is kind of a fairly long look. As far as the price action throughout the last 40 years, just about, there really hasn't been a period where there's been kind of a prolonged bottoming base formation. It's for the most part been a downward trending asset class. However, you did see what looks to be a double bottom in 2012 and again in 2016. The momentum, as I've said, is clearly upwards. A lot of people want to say this is a double bottom in interest rates. Whether it is or it isn't, I think the clear trend in portfolio positioning is towards, shorter duration, taking less interest rate risk, trying to avoid rising interest rates. My particular portfolio positioning has been largely in floating rate securities, playing the spread of particular securities. So, maybe buying high yield bonds while shorting the 10 years. So just kind of playing that spread, avoiding interest rates. So this is obviously a major theme. It could have implication for years to come if we are in, a multi-year rising interest rate environment as we have been since the election. So this is something obviously to watch. Again, with rising interest rates, you've also seen rising inflation. With here specifically, this is the USO, which represents, WTI crude. So you can see here, this has been a very strong asset class. Even amid equity market volatility, This fund has basically trended higher since the end of 2017, and so it's interesting that you've seen interest rates and the price of oil basically trend higher together. Uh, Oil prices and energy prices as a whole are a key component of the consumer price index, and so rising energy prices do indicate, potentially longer term inflation and therefore rising interest rates in the future to combat that. So obviously this move here is very interesting and definitely has implications for both equity markets and bond markets going forward. Similarly, rising interest rates have fueled a rising US dollar. This has weighed on the price of gold. The price of gold has declined, I wouldn't say significantly, but it has been kind of range bound for the past few years, and recently has fallen lower amid the 10-year breaking above 3%. I am trying to avoid the precious metal space simply because there looks to be better opportunities elsewhere. An outright short of this space maybe is a bit premature, but I just think that there's better places to put your money currently than in gold, in precious metals.